All right, it's Money Talk Tuesday. Welcome, everybody. My name is Shaitia Spruill. I am the Senior Program Officer for the Office of Economic Empowerment. And we're going to get started with navigating your student debt. This is presented by the Financial Planning Association of Massachusetts, the Institute for Student Loan Advisors, and Experience Your Wealth. So I'm going to welcome you all. The Office of Economic Empowerment, we're going to talk a little bit about what we do, go over some disclosures, housekeeping, and then we'll turn it over to our presenters for today, which is Betsy Mayo, and Jade Northrup. The Office of Economic Empowerment is a department within the Office of the Treasurer and Receiver General, Massachusetts, tasked with supporting, advocating, and facilitating policies that empower all Massachusetts residents. Our programs serve women, families, high school students, veterans, and seniors. Our priorities include closing the wage gap, increasing access to financial education, improving college affordability, and investing in STEM careers and education. This is our disclosures. This is a Zoom webinar and will be recorded. So we're recording right now. The recordings may be uploaded onto a public site for future use. This webinar is also being streamed live on Facebook. Any information shared through the question function will be anonymous. And please note, however, that the chat record that's at the bottom, we'll go over that in housekeeping, is subject to public record laws and such is not anonymous. Our housekeeping for today, like I said, this is a webinar. It's not a meeting, so you won't be able to see the other participants. You won't be able to speak, control any of your mic or video functions. We also want to highlight that you can use the chat feature to communicate with the host and the panelists, which is myself and our two speakers. You can also use the Q&A function that's on the bottom. If you are in the app, if you're on the phone, you may not be able to see this function. But you can ask questions anonymously through the Q&A section. Please also complete the post survey so we can continue to improve this program. What's going to happen once you close this webinar, our survey is going to pop up and you can just take a couple seconds and answer that. And that is also where you can leave comments for any ideas that you're thinking or would like to see for future Money Talks. And then finally, thank you all for joining us. It's a pleasure to always do these things, but it's also really, really impactful when we hear from you guys. So please do not hesitate to use those question and answer and chat functions. And just so you guys are aware, the Small Business Tips and Resources webinar will be taking place next Tuesday. And then the last Tuesday of May, we'll be talking about teaching our kids about money. And as always, if you have any questions, comments, or concerns, feel free to email us at moneytalk@tre.state.ma.us. And without further ado, I'm going to turn this over to my friend Betsy, and we will hop right into our presentation.
Hi there. Let me just get our slides pulled up. While I'm getting that done, I want to just tell you a little bit about me. I'm Betsy Mayotte. I'm the president of the Institute of Student Loan Advisors, or TISLA. TISLA is a Massachusetts-based nonprofit whose mission is to ensure that all consumers have access to free, expert, and unbiased student loan advice. So anyone that has questions or maybe even a dispute about their student loans can utilize our website or reach out to us via email, and we're happy to help. That website will be given to you as part of the resources, but it's freestudentloanadvice.org. We've also partnered with another nonprofit called Mapping Your Future to create a resource specifically related to the pandemic to help students as well as student loan borrowers who have been affected by the pandemic. And that website is studentaidpandemic.org. So what I'm here to talk to you about today are the waivers that have been issued by Congress and by the Department of Education related to federal student loans, as well as some information about private student loans. This information is changing by the day. In fact, I have an update that isn't even in my slides because it just happened over the last sort of 48 hours that I'm going to be giving you. My attorneys do make sure that I tell you that I am not an attorney, and this presentation should not be considered legal advice. And if you're seeking legal advice, you should work with your own counsel. So with that sort of housekeeping stuff out of the way. So one of the things that's the most confusing about the relief that's been offered to federal student loan borrowers is which loans do they apply to. Any of the waivers that have been issued, whether it be from the administration on March 13th, which was sort of the first wave that we saw, or as part of the CARES Act that was signed into law on March 27th, those only, for the most part, only apply to what they're calling federally held federal loans. Now, that applies to about 75% of the borrowers that currently hold a federal student loan. But where it gets confusing is that there's two primary federal student loan programs, and they're both exactly the same except where they're different. And one of the places where they're different is that most of one type of program aren't eligible for these waivers. So if you have a federal direct loan, then that loan is going to be eligible for the waivers. If you took your federal student loans out after July 1st of 2010, then you absolutely have a direct loan. Prior to 2010, both programs, the direct loan program and the federal, what was called the Federal Family Education Loan Program, were in existence. If you went to college at a time where both programs were out there was probably an 80% chance that you got a FFEL loan rather than a direct loan, because that's just what was made available by the schools. The problem is that both FFEL loans and direct loans, both programs, they have Stafford loans, they have Parent Plus loans, they have consolidations, they have Graduate Plus. So just looking at your loan type isn't going to tell you for sure whether you have what's called a federally held federal loan. But again, if you took your loans out after July 1st, 2010, and it's either a Stafford or Plus or a consolidation, then it's absolutely a direct loan and it's absolutely eligible for the waiver. You took your loans out prior to July 1st, 2010, you're gonna have to do a little more legwork to verify whether you have a direct loan or a FFEL loan. And they're actually, to make things even more confusing, there's actually about 10% of FFEL loans that are considered federally held as well. Now, you can't tell by looking at your servicer, because many of the student loan servicers actually service both what we're calling federally held federal loans as well as commercially held federal loans. Navient, for example, services both. Great Lakes services both. So quite a few of them do. If you're not sure what kind of loan you have, the best thing to do is to call your servicer and ask them, or at this point, just log in and see if the waiver has been applied to your account. If you're showing a 0% interest rate, then your loan is considered a federally held federal loan. And the rest of what I'm going to be talking to you about, you'll know if that applies to you or not. If you're not showing a 0% interest rate, then you almost certainly do not have a federally held federal loan. So again, all direct loans are federally held federal loans. A very small percentage of the old FFEL and Perkins loans, and all of this includes defaulted loans, if it's a federally held defaulted loan. Non-federally held loans is 90% of the FFEL loans and about 90 or 95% of the Perkins. Again, there's a very small percentage of Perkins loans that are also considered federally held. If you took your loan out from the state, for example, Massachusetts no interest loan, that's not going to be eligible for these waivers. You took your loan out directly through the school or through a private lender, those loans are also not going to be eligible for those waivers. So on March 13th, the administration announced sort of the first set of waivers. It was a 60-day hold on payments that you had to request, and you would get a 0% interest rate. If the loan was already delinquent, then they were going to automatically put this waiver on your account, regardless of whether you asked for it or not. But if your loan was on time, you needed to go in and ask for it. And again, it was only for 60 days. Then on March 27th, the CARES Act was written into law. It got signed into law at about 5 or 6 o'clock on a Friday night on March 27th. And this caused a lot of confusion for consumers because the waivers in the CARES Act, now they supersede the ones that were announced on March 13th, but they were very similar. So a lot of people got confused over what applied to them and what didn't. What the CARES Act did is it applies a 0% interest rate to all federally held federal loans through September 30th of 2020. You don't have to ask for it. They've already done it if you were eligible for it. If you were on automatic payment through your servicer rather than something you initiated yourself through your bank, those automatic payments were going to stop. The really interesting thing, and the part that people are a little squirrely about because it sounds too good to be true, but trust me, it's absolutely true, is that if you're pursuing forgiveness under either public service loan forgiveness or an income-driven repayment plan, this period of time is going to count just like you were making a payment. So I've run in, we do a lot of work with borrowers on public service loan forgiveness, and we've run into a lot of them that are just so anxious about losing eligibility for the program that they've decided to make payments anyway. And I'm here to tell you in all capital letters, do not do that. All you're doing is stealing from yourself. You're not going to get double credit for payment. They're not going to push your payments ahead in a way that will help you for PSLF. So you're literally just sort of throwing money into the wind by doing that. So if you're pursuing public service loan forgiveness and you're fairly certain that you're going to stay working for an eligible employer for the full 10 years needed, there is zero reason for you to be making a payment during this waiver period. And I would almost argue that doing so might actually harm you. So I would put that money aside in a separate savings account, use it towards other bills or other debt if you need to, but do not be making payments if you're pursuing PSLF or an income-driven repayment plan and you're pretty confident that you stand to get forgiveness. The other nice thing about this waiver is that normally when you have some sort of postponement of payment, any interest that has accrued at the end of that postponement is going to end up being added to your principal balance, or another word for that is capitalization. This waiver will not cause capitalization. Now, with that said, there are other events that could happen during the waivers or just before or just after that could cause your interest to capitalize. For example, if you were in some type of deferment or sort of everyday forbearance prior to this waiver being applied, then at the end of the waiver, the interest that would have capped as a result of that initial deferment or forbearance is still going to cap. But if you didn't have that situation prior, then again, you shouldn't have to worry about any interest capitalizing. Now, some of you might be saying, well, Betsy, you said it was a 0% interest rate. Why would there be any interest to capitalize anyway? Well, there might still be outstanding interest that accrued prior to March 13th, which is the effective date of these waivers. Now, credit reporting, I'm going to get into this in a little bit of detail because I mentioned that things are changing rapidly and something has changed just in the last day or two. This is that thing. So before I get into that, I just want to take a breath and see if we have any questions so far.
We have one. So far, it is, where can I learn about student loan forgiveness programs?
A great question. So on our website, freestudentloanadvice.org, we have a forgiveness page. And on that forgiveness page are all the gory details in plain English on public service loan forgiveness, teacher loan forgiveness, the income-driven plans, all the discharges, death, disability, borrower defense discharge, ID theft discharge. But even better, we have a database of all the forgiveness programs that we know about, and there's actually over 100 of them. Most of them are state-based. Many of them are profession-based, but you can go to that forgiveness page and find that database and get more information there. If there's no other questions related to the COVID stuff, I'm going to get into the credit reporting. Good?
And just before you transition, I dropped that link for folks who are on the app or on your phone, computer. You'll see it in the chat box.
Thanks for doing that. Okay, so credit bureau reporting. So under the CARES Act, they're required to, so normally if you're in a forbearance or in deferment, they report you to the credit bureaus as in forbearance or in deferment. Now, as an aside, let me just say that I'm not a credit bureau expert. I do know, however, that a deferment or forbearance is not intended to be a negative mark against your credit score. I'm starting to learn a lot more about credit scores because of what's going on right now. And my understanding is that some of the credit bureaus sort of score the deferment and forbearance in a way that perhaps they might not supposed to score it that way. But regardless, the CARES Act, they're supposed to, the servicers are supposed to report your loan. If your loan is under one of these waivers, they're supposed to report it, not that it's in forbearance or that your payments have been postponed, but they're supposed to report it just like you were actually in repayment and making on-time payments, even though you're not. So unfortunately, because of the timing of when the law went into play and the timing of when the servicers are required to report every month to the credit bureaus, some of the servicers were not able to get all the programming updated on their servicing systems in time. So their monthly deadline for credit bureau reporting is actually the 10th of the month. So with weekends included, they had less than a week between when the CARES Act was written into law and this brand new thing that never existed before. So prior to this, there was no such thing as a deferred status that had to be reported as a loan in repayment. So again, some of the servicers did not get all their programming done by the April 10th drop dead date for their credit bureau reporting requirements. So they did report borrowers as deferred rather than reporting them as in repayment or in this special status. So I started hearing on right about Friday night of borrowers who saw their credit scores drop as a result of this deferred status. Now, whether they should have dropped for being in a deferred status is a whole other conversation, but they shouldn't be reported as deferred. So some people, rightly so, were really upset by this. I was able to find out yesterday from the Department of Education as well as the servicers that situation has been resolved and was updated as of the May 10th reporting. And it was updated in a backdated way. So it should go back to March 13th. So any of you might have seen a credit score drop and nothing else changed on your credit report other than the status, should see it go back to what it was before. Some people I've actually heard from this morning, some people have already seen the update. I would expect most of it to take a couple weeks, but if by the end of the month, you're not seeing it back to the way it was, then I do encourage you to contact your servicer. But that's sort of that's the latest of what's going on with this credit reporting issue. Okay. All of this should have already happened at this point. The Department of Education was given 15 days from the enacting of the CARES Act to notify borrowers. We already talked about the credit reporting. Now, for federally held federal loans that are in default, those are also going on hold and getting a 0% interest rate for this period of time, March 13th through September 30th. Some other things that are going on with defaulted loans, however, is you're not going to, if you have a defaulted loan, you should no longer be receiving any type of collection activity. Any tax refunds that were garnished after March 13th should have been returned to you by now. You shouldn't see any further tax refunds being garnished. Administrative wage garnishment was also supposed to stop. That was effective when the CARES Act got written into law. I do understand, however, that not all wage garnishment has stopped. I don't know if the issue is with the various collection agencies or if it's with the employers, but I am seeing that there is still some wage garnishment going on. If your wages are still being garnished and you know that you have a direct loan, you can, if you need the money back, you can call and ask for that money to be refunded to you. Any garnishment after March 13th. That also includes Social Security garnishment. Again, this is for federally held federal loans. You're not going to be receiving any more outgoing calls or any other type of collection activity. Now, that doesn't mean your loan's not still in default, and it doesn't mean that you can't be making payments if you can, or better yet, trying to resolve the default. It just means that you're not going to be getting the phone calls. Now, there's a process called loan rehabilitation that allows you to get a federal student loan out of default, and it's kind of awesome. It's awesome because not only does it get you out of default, but it removes the default line from your credit report like it was never there, and it drastically reduces the collection costs. And of course, it puts your loan back in good standing. Now, to get that program, you need to make 9 consecutive on-time payments in an amount that's based on your income. What the CARES Act does is if you are already under a loan rehabilitation program, you can actually not make payments during this 6-month period of time, and they're going to treat it like you did. This is a huge gift. So for example, if you were 3 months into loan rehab when the CARES Act was written into law, you don't have to make another payment. And come October, you will be taken out of default, and the loan will be considered rehabilitated, assuming you've signed your paperwork and done everything else you're supposed to do. So if you have a defaulted loan and you haven't really taken any action on it, now's the time to do it. Call the collection agency and get started on a loan rehab program now. Or if rehab's not the right solution for you, see if you can consolidate the loan out of default. Now's the time to do it because of the 0% interest rate and the cessation of involuntary collections. How are we doing on questions?
So far, so good. No other questions at the moment, unless people want to drop them in the Q&A box now.
Okay, I'll keep going. I want to make sure we have plenty of time for Jake and other stuff. So I'll keep going, but I'll be sure to ask for questions again before we transition. Okay, so borrower communication. So listen, we're in the digital age. I am just as guilty of this as the rest of you in that I don't open most of my mail. I pay all my bills on time. I pay them online. So I can't remember the last time I opened my electric bill that came in the mail, for example. For those of you with student loans, starting in August at the very least, if not before, start opening your mail. All of it, your email, your snail mail, if it comes by OWL, if it's from the Department of Education or it's from your loan servicer, you need to start opening your mail. That's because the CARES Act requires that starting in August, they're required to do a minimum of 6 reach outs to you. It could be by phone, it could be by OWL, it could be by snail mail, and that's to inform you of what status your loan's going to be in and the fact that the waiver is coming off and when your next payment's going to be due. If you miss that and you become delinquent and it affects your credit, or worse, you default, that is going to be on you. So it's really important that you keep up to date with what's going on. Again, I would expect the law requires that they make a minimum of 6 attempts. I wouldn't be surprised if you saw more than that. Now, for those of you that have loans that aren't eligible for the waivers, I'm going to talk about what options are available to you. But before I do that, did you have another question that popped up?
We just had one that popped up asking if we could get the slides, or if attendees can get the slides following this presentation.
Yeah, I'll PDF mine to you if you, I don't know if you have a way to distribute them or not. But I can watermark and send them to you to distribute if you like.
Sure.
Okay.
And
so
I have one other question, Betsy.
Okay.
What if your loans are being deferred?
I think I need more to that question. So if you have a federally held federal loan, then your loan is under the waiver right now. It's not under any type of deferment. The only exception to that would be is if you were actually in school and in an in-school status or your grace period, at which point, they are still going to be in their grace period or in-school status. You're still getting the 0% interest rate. But if you were in, say, an unemployment deferment prior to March 13th, they would have transitioned that unemployment deferment to this COVID waiver, which is essentially a forbearance.
Okay.
All right, so
I think this is a follow-up to that last question, but you may have answered it. Went back to school to get another degree, and now the loans are being deferred because you're in school, I'm assuming?
Yeah, so if he or she were in school at least half time, then they would be in school deferment. My understanding is that the in-school deferment would have been replaced by the waiver status, but unless you were pursuing public service loan forgiveness, it sort of doesn't matter because no matter what, you're getting the 0% interest rate. So it doesn't. It's sort of the same thing of whether you're in an in-school deferment or whether you're under this waiver. Okay. So for non-federally held federal loans, there's really not much new as compared to other prior disasters. So, I've been doing this kind of work since the dinosaurs roamed. So this is not my first disaster, but this disaster is still very unique as far as how it's being handled with the relief that's being offered consumers. So, but prior to this, so say 9/11, Katrina, the California wildfires, there was standard guidance that the student loan servicers had to utilize in the case of a disaster. What's unique about this disaster, the pandemic, is that it's affecting the whole country at once, whereas these other disasters were localized. So there's a provision that allows the lender to put what's called a disaster forbearance, a 90-day disaster forbearance on any account that's in a zip code that's been declared a disaster area. So because this is a little different, whereas the whole country is being affected by the pandemic, what most of the servicers are doing is they're applying the disaster forbearance if the borrower asks for it, which makes sense. Because while there's a ton of people that have been negatively impacted economically by the pandemic, not everybody has. So there are still plenty of people that can afford to keep making their student loan payments. But for those that can't, if they call, they can ask for this 90-day forbearance. Now, is that the best solution? I would say for most people it isn't. Because with just like any other forbearance, with the exception of this CARES Act forbearance, interest is still going to accrue on your loans. You don't get the 0% interest rate if you don't have a federally held federal loan. And at the end of that period, the interest is going to be added onto your principal. So you'll be accruing interest off of interest. So while taking a disaster forbearance is better than defaulting, to me, it's sort of the last resort because you sort of end up in a worse place than when you started. Now, if there's a situation where they automatically put a disaster forbearance on your account and you don't want it, you can call right away and ask for it to be removed, and there won't be any negative consequences to it. Any payments, if you're pursuing forgiveness under income-based repayment on a commercially held federal loan, this period of time, unlike the CARES Act waivers on the federally held federal loans, this period of time will not count like you made a payment for the purposes of IBR or for the purposes of your credit report. So there's definitely a lack of parity between these programs. Now, there are some people that are considering consolidating their commercially held federal loans into the direct loan program, which you can certainly do. You do that at studentaid.gov in order to get the 0% interest rate. I don't know if that's worth it. For some people, it might be, but the 0% is only for a couple more months. And then after that, you end up with your consolidation loan interest rate, which is a weighted average of your underlying loans, rounded up to the nearest eighth of a point. So you'd have a 0% interest rate for a couple months and then a slightly higher interest rate for the next 25 or 30 years, whatever the term of your consolidation loan is. And if you're pursuing forgiveness under IBR, consolidating means you're starting from scratch. So consolidation may not be a good solution. Income-based repayment or any other of the lower payment options are potentially better solutions than a disaster forbearance if you're struggling during this pandemic. There's also something called an economic hardship deferment that you can look into. We don't have the time to go into the gory details of those programs, but I have them in gory detail and in English on our website. So certainly check that out. Or call the servicer and they'll help you walk through what the best solution might be for you. Now, for commercially held defaulted loans, all collections has stopped for those as well. Again, it doesn't mean that you're not still in default, you don't still owe the money. The difference is that if you are pursuing a loan rehabilitation program, while this period of time won't kick you out of the program and make you restart it if you don't make payments during the 6 months, they're not going to count it as a payment. So as for a federally held federal loan, if you were 3 months into rehab, you could go the next 6 months without paying and they would take your loan out of default on that 9th month. For a commercially held defaulted loan, if you were 3 months into rehab, you could still not make a payment for the next 6 months, and you'll still have the first 3 months under your belt come October, but you'll still have to make another 6 consecutive payments. So it won't hurt you, but it won't help you, is the difference between the two programs. You should not be receiving any more outgoing calls from a collection agency trying to collect a loan from you. If you are, I want to know about it. Email me through my website because that should not be happening. AWG was also supposed to stop. As I mentioned earlier, I do know there's some hiccups with that, but if your wages are still getting garnished, you can call and ask for that money to be refunded. Same with tax offset. If they took your tax refund after March 13th and you need it back, you can call and ask for it. You can call and ask for it back. Private and other non-federal loans are trickier. Historically, private loans, for the most part, don't have a lot of options for relief in the best of times. Most private loan programs will offer you some sort of forbearance. Some of them charge you a fee for the privilege. I would like to think at this point, they may no longer be doing so. Every private lender is different. Even under a single private lender, they might have multiple private loan products that have different options for relief. I do know that some private lenders that are considered non-banks are able to offer more robust relief programs, but they tend not to advertise them. So the moral of the story is if you're struggling, call and ask what they can do to help you. I think every one of them will be able to offer something, just as how generous or how helpful that relief I think is going to vary based on the lender and based on the loan program. The last thing, or one of the last things that you need to know is if you're not getting collection calls, not only does that not mean you don't know the money, but it could also be because your state has put a temporary moratorium on all collection activities on all consumer debts. Nevada is one of those states. The Commonwealth was talking about it, and I have to admit I lost track of that. I don't know if it actually passed or not. So again, just because you're not getting calls doesn't mean you're not past due or delinquent. And this applies more to the private loans than anything else. So make sure that you are aware of the status of all your financial accounts, not just your student loans. Just sort of as an umbrella, things to remember. If you can afford to pay during this 0% interest period, you should absolutely do so. Make sure your emergency fund is bulked up. But after that, you're paying on a 0% interest loan. Why not get a chunk of it out of the way while you're having that benefit? You shouldn't have to worry about capitalized interest unless you had another event that would normally cause capitalized interest. If you're pursuing PSLF, you should not be making payments at this point. And if you're still struggling after the waivers are lifted, you want to look at things like unemployment deferments and lower payment options. Now, there is talk of additional stimulus bills. I don't know if that's going to happen or not. And even if it does, I don't know if they're going to address anything related to student loans. I think Congress feels like they already gave a big gift to student loan borrowers. And there's plenty of other things out there they need to spend money on, healthcare, unemployment, that kind of thing. With that said, there is a lot of pressure on Congress to extend these waivers to that 25% of federal student loan borrowers that currently aren't getting them. I think that has a shot. It just sort of depends on what happens and the when of what happens with any future stimulus bills. And with that, that's what I have. I'm sure we'll ask for more questions at the end, but I'm ready to turn it over to Jake if Jake's ready to be turned over to.
I am. Thank you, Betsy. Let me start sharing my screen and I'll turn my video on. everyone see I think I can see my screen. Cool. Hi, everybody. My name is Jake Northrup. And before I dive into some of the details, just wanted to quickly give you a rundown about my history. So I'm the founder of Experience Your Wealth. We specialize in helping young families with student loans find that responsible balance between paying off debt, investing for the future, but also experiencing life now. I previously worked at a firm in Boston, helping people with roughly 5 million of net worth, which was a great experience. But I really wanted to help people when they were making their money, as opposed to when they already made their money. We're virtual. We have clients all over the country. I work with people on an ongoing basis and a one-time project basis as well. I'm a certified financial planner, a chartered financial analyst, and certified student loan professional. It's basically alphabet soup. And what that means is I worked hard, I studied a lot so that I could learn all the technical stuff. I love to teach and be involved. So I teach retirement planning and employee benefits at Boston University. And then I also lead the next generation of financial planners for the Financial Planning Association. So that's a organization of financial planners in Massachusetts. There's over 800 members. So if you're looking for a financial planner, looking for some help, it's a great resource for you. And most importantly, you're probably wondering, why is there a picture of me by the Great Pyramids? That's my wife and I, we love to travel. So for us, this is how we experience our wealth. We definitely have that travel bug right now, having to wait on, but I wanted to give a little bit of background before I jump in. All right, so Betsy really laid the foundation for the loan overviews, the state of student loans right now, and I'm going to shift gears a little bit and go into repayment strategy. So especially once the student loan interest waiver is up, how are you thinking about paying these down? And I'm going to give you some framework to go through. All right, so take a breath. I'm about to go through a good amount. I hate that there's this amount of words on here, but it's a lot of important information. So the types of federal repayment plans, there's 7 overall, and not all loans are eligible for these repayment plans. Honestly, it's confusing as hell. I'm just gonna go through the most common types of repayment plans that you've probably heard of, you're already on. Number 1 is the standard 10-year repayment plan. It's very simple. You pay a fixed amount every month for 120 months. So your loan is paid off after that 120th payment. Now, this can be really high if you have a high loan balance. So if that's just too much for your monthly income, that's where one of these income-based repayment plans are, sometimes referred to as IBR. And those payments are based solely upon your income, not your actual student loan balance, right? So the best plan is usually, it's called pay as you earn. And in this plan, you pay about 10% of your income after some deductions. And the good news is there's a maximum payment amount. So let's say you won the lottery and now you have $1 million. There's a maximum payment amount. You can't exceed the monthly payment that would have occurred if you went into standard repayment when you entered. So it sounds good. The downfall is that not everyone is actually eligible. So you could not have had loans prior to October 1st, 2007, and you had to borrow after October 1st, 2011. You're like, what did I just say? That's why it's so confusing. So not everyone is eligible for it. But if you are eligible for this plan, it's a really good plan, and you can exclude your spouse's income if you're married by filing taxes separately. So we'll talk about that in a little bit. The next best repayment plan is called Revised Pay As You Earn. It got its name because Congress basically had no idea what it was doing and recognized Pay As You Earn really left a lot of people out and they weren't eligible for it. So with Revised Pay As You Earn, you're eligible for this if you have direct loans only, all right? So no FFEL loans. There's no maximum repayment amount. So this means that if your income significantly goes up, it means that your student loan payment doesn't have that ceiling and you could pay a good amount there. And then as opposed to Pay As You Earn, you can't exclude your spouse's income, right? So if you get married, regardless of how you actually file taxes, your spouse's income would actually now be included in that. And then another plan, a little bit more rare, but if you are a parent and you're borrowing for your kids' education, you're eligible for a plan called Income Contingent Plan, or ICR. Unfortunately, it's the only repayment plan that is eligible if you have Parent Plus loans. It has a little bit higher payments. So payments are based on roughly about 20% of your income after a little bit of a deduction. But the good news is you can exclude your spouse's income by filing taxes separately. So, whoa, I just said a lot. I'm going to pause for a few seconds and see if any questions come in there, but it's helpful to set up some of the framework when we talk through strategy.
If anybody has any questions, just reminding you all, you can use the chat and the Q&A function at the bottom of your screen.
I will continue, and we can address any questions that might come up from there.
Okie doke.
So if you really simplify everything and you think through, how am I going to be repaying these? I've simplified it into 3 camps, and we're going to go through what each of these mean. One would be paying them down as fast as possible. 2 would be paying down the loan, but with some flexibility behind it. So maybe not as fast, but you're still set on paying it off. And then 3 would be paying as little as possible and going through one of the loan forgiveness programs that Betsy talked about. All right, so number 1, here's some framework to think through. So pay down as fast as possible if, number 1, your income exceeds your loan balance. Number 2, your income is steady. In other words, you might be a W-2 worker. There's a low likelihood of you losing your income. You're pretty steady in that. You're confident in it. Number 3, your loans have a high interest rate. So I would say over 5% or so. You might have loans from grad school, or you might have gone to undergraduate school and interest rates were a little higher. Number 4, you have a sufficient emergency fund. What this means is you have about between 3 to 6 months of living expenses saved up. And when I say saved up, it doesn't mean in the 401k or an investment account. It means in your bank account. So that should be at minimum probably about $10,000 saved up for emergencies that come up. And then number 5 is there's a low opportunity cost for the money. In other words, you'd probably just let it sit in the savings account. You wouldn't let it do much more. You might not have any other big goals on the horizon, like buying a home or traveling or something like that. So if this is the case, you probably want to look into refinancing at some point. I wouldn't recommend doing it right now, just given that you're paying 0 interest on these loans. But if you are set on trying to pay them down as fast as possible, what you can do is get a much lower interest rate when you go to a private lender. Now, I do caution you, because if you do refinance, you lose a lot of the flexible features that federal student loans have. Such as loan forgiveness, such as discharge and death or disability, the ability to pause payments. So with some help, you might be able to run what's called a net present value calculation. So I was working with a client recently. He had about $30,000 of federal student loans, and we were talking through, do you refinance these? Do we not? And refinancing only resulted in an extra savings of about $2,000 in today's dollars. So he thought, okay, how do I place the value of the flexibility on one hand versus the savings on the other hand? And he felt like I'd rather keep that flexible feature of federal student loans. So it might be a good path for you. Just be aware of what you're giving up by doing it. And what if you're already refinanced? So look again, because interest rates have really declined this year. You might be able to get a better deal compared to the last time you refinanced. You can always shop around for rates. I put in a resource here. www.studentloanplanner.com has some good deals there. From what I've seen, First Republic really offers the lowest private rates, but you have to have a good credit score. You have to do banking with them. And there might be some other features, right? So you might have refinanced a few years ago, but they required a cosigner. So you might have had, mom or dad sign on with you. and now you have more credit history, you have more reserves, your income's higher, and you might be able to qualify at a new bank and not have that cosigner. Now, camp two, my guess is probably this is where most people will fall, is to pay down, but with some flexibility. And this makes sense if your income, again, is greater than your loan balance. So let's say you're making $50,000 a year and your loan balance is $30,000, your income's greater. Therefore, you're probably not going to qualify for taxable loan forgiveness over the long term. Two, your income is more variable. So you might be an independent contractor, a business owner, you might be paid on commissions. In other words, you might not feel great about where your future cash flow is coming from right now. Number three, your loans have low interest rates. So maybe you went to undergraduate school when interest rates were low. You know, I've seen some federal loans at 3.5%, 4%, and that's a pretty good interest rate to be borrowing at. Number four, you might not have that 3 to 6 months saved up in a bank account. So I would really focus in on building up your emergency fund before changing anything with your student loans. Think of it as, you know, building strong financial roots so that when your tree actually grows, it's on good roots. If you don't have that good emergency fund, you're growing a tree on really weak roots. And then lastly, there's a high opportunity cost with the money. In other words, you might have goals like a down payment or a wedding, or you can contribute to your 401k. In other words, you wouldn't just let your cash just sit there. So if this sounds like you, the most feasible option is likely to enroll in an income-based repayment plan, some of the ones that we went through on 2 slides ago. Now, I did see a question pop in, so I will pause there.
It says, are there cosigners on federal loans or just private loans?
Just private loans, and that's a good question. So you have to, on private loans, you should be able to see in the promissory note, you might be able to log in and see it. It is something you definitely want to look at because you might have taken out private loans during undergraduate school, and technically some loans say if you were to pass away or something happens, that other person's on the hook. So if there's an option, there's something called a cosigner release where a private bank might feel comfortable saying, hey, we don't need mom and dad on anymore. And you might be able to just pay based on your history. So typically you want to avoid cosigning loans if possible.
Actually, Jake, while you take a sip of water, just to make sure there's no confusion, federal plus loans, whether they be graduate or parent plus, they actually have what's called an endorser. An endorser is not the same as a cosigner, but they are secondarily liable for the debt.
Right, thanks for clarifying that. All right, so then the third camp, and this is one where you want to pay as little as possible. So Betsy mentioned something called public service loan forgiveness and taxable loan forgiveness. I know she mentioned she had some resources on her website, really high level. I know there's going to be, I think, a future webinar that goes into more details with these, but public service loan forgiveness occurs when you work at a nonprofit, you have the right type of loans, so it's direct loans only, and you make 120 qualifying payments while on an income-based plan. So it is possible. You might have seen the statistics out there that 99% of people were denied this, but in fairness, most people had zero shot in the first place. So if you're at a nonprofit, I would definitely be looking at this and just understanding some of the qualifications, the record keeping with that. And then another feature is what's called taxable loan forgiveness. So in particular with point number one here is if your student loan balance is greater than your income, so there's, if you are a doctor, a lawyer, a dentist, some of these really highly indebted degrees, you might want to look at taxable loan forgiveness. And what that means is after 20 or 25 years, depending on your repayment plan, the remaining balance, if any, is actually forgiven. Now the downfall is that's taxable income to you, whereas with the public service one, it's tax-free. So I know that was a lot, but if you are pursuing one of those programs, you really want to pay as little as possible, right? So if you're at a nonprofit, a government agency, or if you own your own business, I'm going to talk about that in a little bit. Number 3 is if you have really high interest rates, that would mean paying off these loans would be difficult. So if you have grad plus loans or other loans that are over 7%, something like that. Number 4, if you don't have an emergency fund, so we talked about that before, building your financial roots. And then 5 is the high opportunity cost of that money. So if this sounds like you, I would definitely consider income-based plans, repayment plans, and then look at forgiveness features as well. I'll pause there for, I know we have about 10 minutes left. I'll pause there for maybe 30 seconds or so and see if any questions come in from there. All right, so I'm gonna transition now into thinking through your loans when some life transitions occur and how to manage them. So the first one is marriage. And a cool fact, this is actually a photo from my wedding. We actually got married in Greece. My wife is a wedding planner, and the best advice I give people is to marry a wedding planner. All I had to do is show up. She planned a beautiful wedding, but I get bored with some of those random unsplash photos, so I try to personalize it. So if you get married, your student loans will be impacted if you are on an income-based plan. So if you file taxes jointly, then your spouse's income would now be included in your student loan calculation. So that can greatly increase your payment. A lot of people think, oh, we're getting married, you file taxes jointly, but you have to be careful to consider how that impacts your student loans. Now, if you file taxes separately, you can exclude your spouse's income as long as you are on revised pay as you earn. Right, so if you are pursuing public service loan forgiveness, your goal is to pay as little as possible. So therefore, you would look at filing your taxes separately to lower those payments and really maximize that benefit. I totally forgot I had that wording in here. If both spouses are on student loans, if you both have them on income-based plan, it's just really complicated. I recommend asking someone for help. It's like a prorated calculation for you, but there's a lot of variables there. All right, next is buying a home. So when you think through buying a home, lenders will look at usually your debt to income ratio, your credit score, and then maybe the assets that you have. So how your student loans are treated depends on the type of mortgage you're getting. All right, so one is called an FHA mortgage. It's as if you're putting very little down payment, so less than 5%. So in that case, the lender looks at the greater of 1% your outstanding loan balance or the actual payment, right? So if you're on an income-based plan and your income's low, your payment might be low, but then if you have a high student loan balance, you might get dinged there. So you have to look out for that. But conversely, if you're looking for a conforming loan or a jumbo loan, so you're putting more than 5% down, the lender only uses your current payment amount. In other words, your total loan balance is excluded. You could have $500,000 of student loans, and if you're paying, $100 a month, that's what they're looking at. So let's say you have a goal of paying or buying a home in the near future, and you're currently on that 10-year plan, that standard repayment. You might want to switch to an income-based plan for the next few years, so that when you go to apply, your debt to income ratio gets better. And then you can always go back later on. So thinking through ahead and saying, hey, if buying a home is a goal for us, then we want to be sure that our student loan strategy is matching that. I'm going to skip this just in the interest of time. Just high level overview is if you're starting a business, it likely makes sense to enroll in an income-based plan because your income will be really low, frees up cash, and when you're starting a business, cash is king. And then if you are a parent, what you can do is borrow parent plus loans. So typically, if possible, you usually want to refrain. If you have the ability, usually taking on debt later in life is a little bit more challenging, but there is an option of having Parent Plus loans. If you want to borrow for your children's education and you might not have the money saved up in a 529 or anything like that. And I'm purposely going pretty quick right now because I know we have that 1 o'clock end. So key takeaways, thinking through, all right, what are some things that we can walk away from this webinar and think through? So number one, you always want to incorporate your student loans into your other financial goals, right? So it's not like your student loans are on an island. You want to think through, how do our student loans play into buying a home or starting a business? So you're looking at that full puzzle picture. Number two, if you're struggling with payments, as Betsy said, always contact your loan servicer to help. There's a lot of options with federal loans to help you in the short term. Number three, beware of scammers. So there's a bunch of companies that try to scam people with student loans. They might say, hey, we're a private consolidation company and we'll help you do things that you could do on your own by working with a federal loan servicer. And then number four, just speak with an expert, especially if you're going for loan forgiveness. So whether it's public service loan forgiveness or taxable loan forgiveness, because you want to minimize any likelihood of not getting those forgiveness features in the future. So thank you all. So if you want to stay in touch, you can check me out by going to my website, www.experienceyourwealth.com. You'll see my LinkedIn, Facebook, Instagram, Twitter, the whole 9 yards there. Here's a link to Betsy's free student loan advice.org. And then we also put in some resources here, so you can visit fpama.org. That's the Financial Planning Association that I mentioned before. So they have a Find a Planner tab if you're looking for a certified financial planner to help you navigate through these and also incorporate your overall finances. So I saw a question come in.
Yes, we had one question come in. I think it's in regards to something you said about being the experts. Who are the experts?
Yeah, it's a good question. I think, obviously Betsy's organization helps with student loans. I help with student loans as well. I do a one-time student loan review for people for a fixed fee. There's other financial planners in Massachusetts that definitely look at student loans. So if you go to the I'll go to the last slide. If you go to the Find the Planner tab for the FPA Massachusetts, you should see some specialties there. So helping someone just help you understand how do the student loans factor into your other goals. I can't stress that enough, where it's a big payment, it's a big debt, but you should also think through what are some other things that it ties into.
Yeah, for sure. And I would add that, for more of the front end stuff, like saving for college or figuring out how to pay for college, we're really lucky. There's a lot of free resources out there. Here in Massachusetts, there's an organization called You Aspire for families with younger students that are maybe trying to figure out what their higher education path is to begin with. There's American Student Assistance. Again, that's also free. There's a company called, another nonprofit out of Texas, but they're national, called Mapping Your Future. They're great for front end stuff. And of course, TISLA, for people that already have student loans, our resources are always free as well.
I know I had mentioned this in the chat a couple of times, but if you are looking for any of the resources, links, information, you can also email us directly at moneytalk@tre.state.ma.us to receive any of this stuff in attachment form. If you have any more specific questions, we're happy to answer them that way. Like I said, you will be receiving, what will happen once you exit out of here is a survey is going to pop up. You can help us improve these by giving us feedback there, suggesting any future topics you'd like us to cover. And also we will be sending out a follow-up email with the links and how to contact Jake and Betsy. For right now, we can't copy all of the resources in the chat, but you will be receiving the links in the follow-up email. So I know I just got a question about that. If you guys have any last minute questions, I'll hang around for another 60 seconds. But thank you so much, Betsy and Jake, for presenting for us today on navigating student debt. There will be a future student debt conversation that is scheduled for June 9th. But that's going to be more specific to the loan forgiveness program. So if you have questions or you're interested to learn about those, please check us out on that Tuesday. Follow us on Facebook to see the upcoming schedule for June. And unless anybody else has anything else, thank you all for joining us. That's a wrap.
Thanks for having me. This was fun. Have a
Thanks.
good afternoon, everybody.
Have a good afternoon, everyone. Bye now.
Bye-bye.